Am I making this decision out of fear or calm? The hidden psychology behind investment decisions. In financial decision-making, one of the most important but often ignored questions is simple. Am I making this decision because I'm afraid or because I'm calm? Many investors believe they are acting rationally, yet psychological research shows that emotions, especially fear, play a powerful role in shaping financial choices. 1. Fear-based decisions. Fear is one of the strongest drivers in financial markets. During uncertainty or volatility, the brain shifts into a protective mode. The goal becomes avoiding loss rather than making a good decision. Behavioral economists described this through the concept of loss aversion, which was developed by Daniel Kahneman and Amos Tversky. Their research showed that people feel the pain of losses about twice as strongly as the pleasure of gains. Because of this, investors often make decisions driven by fear. Typical signs of fear-based investing. 1. Panic selling. Selling assets quickly during market declines to avoid further losses. 2. Chasing safety. Moving money to cash or safe assets after markets already dropped. 3. Overreacting to news. Making decisions immediately after reading headlines. 4. Short-term thinking. Ignoring long-term plans because of temporary market movements. Fear-based decisions often happen fast, emotionally, and without a clear strategy. 2. Calm-based decisions. Decisions made with calmness usually come from prepared thinking rather than emotional reaction. In psychology, this difference is often explained using the thinking, fast and slow framework. System 1 fast, emotional, instinctive. System 2 slow, rational, analytical. Fear-based decisions come from System 1, while calm decisions rely on System 2. Characteristics of calm investment decisions. 1. Alignment with a plan. The decision follows a previously defined strategy. 2. Time for reflection. The investor pauses before acting. 3. Risk awareness. The decision considers both potential losses and long-term outcomes. 4. Emotional distance. The investor does not feel urgency or panic. A calm investor asks questions like, does this decision match my long-term strategy? Would I make the same decision if the market were closed today? Am I reacting or thinking? 3. Why the brain defaults to fear. From an evolutionary perspective, humans are wired to prioritize survival. Financial risk activates the same neural circuits associated with physical danger. Studies in behavioral finance show that market volatility increases stress hormones like cortisol. Stress reduces analytical thinking. Investors become more impulsive under uncertainty. This explains why even experienced investors sometimes act emotionally during market stress. 4. A simple self-test before any investment decision. Before pressing buy or sell, investors can ask themselves 3 questions. Would I make this decision if the market were closed for a week? Is this part of my plan, or a reaction to price movement? Am I trying to avoid pain or follow a strategy? If the answer points toward emotion or urgency, the decision may be driven by fear. 5. The quiet advantage of calm. One of the most underrated advantages in investing is not intelligence or speed, it is emotional stability. Investors who make decisions calmly tend to trade less frequently, follow consistent strategies, avoid emotional mistakes. Over time, this discipline can become a powerful advantage. Final insight. Markets reward not only good strategies, but also good emotional control. Sometimes, the most important investment question is not, is this the right asset? But rather, am I making this decision out of fear or out of calm?